A very good morning and warm welcome to Money Sense, starting 5 seconds early this morning. I'm Simon Caudry, and I have the pleasure of being joined in the studio this morning by my co-host, Amy Hubble. Good morning, Amy.
Good morning. Is this the best we could do?
We are the best, aren't we?
I think so.
Okay, there you go. Sure. And football season starts. You told me about this.
That's right. College football season kicks off this Saturday.
So there's at least one football fan of Oklahoma State?
No, Oklahoma.
Oklahoma.
The University of Oklahoma.
University of Oklahoma, right. Okay, let's get on to more, slightly more important matters.
If you say so.
Okay. Our show this morning is going to be a conversation between you and I, where we're going to perform a lobotomy upon you and ingest all the information that's in that brain and digest it amongst our audience. That's the plan here today.
It's awfully early for that, but let's give it our best try.
Okay. So one of the topics that we want to talk about, and we haven't really on this show talked about this for a while because we've had lots of different guests on talking about very specific things, but we haven't really talked about where the devil we are in the markets today, because it just seems to be, 3 years, 4 years, going back, just things keep going up. And you're dealing with individuals on a daily basis, and they must be loving the fact that their portfolios continue to go up. But there must be some angst that people have, which is things don't always go up. I think Newton had it best that there is this thing called gravity, and so not everything can always go up without it being fueled or propelled. So what's your take on this?
Yeah, it's funny, and obviously, at least from the S&P standpoint, we are still up over 20% on the year, so it's still been a great year. We're 2/3 through.
And we still have a pandemic.
And we're still in the middle of a pandemic, although the United States has decided to be over it, so
yes.
It is pretty much fully open. But you look back even from a year from past, and we are up double since the low of March. Now, you kind of look at that and you're just like, okay, well, the market's gone up 100%, but you still do have to consider that base rate, that it just fall off 30, 40%, and then it rose from there. So we're about 30% up from the highs of last February, which
And last February, so before the pandemic, we're up 30%. Despite there being a pandemic, despite lots of people dying, despite lots of things that we'll get to, we're up 30%, which means everything is absolutely fantastic, in theory.
Which has been great if you stayed in the market and have just ridden along. But now you have a lot of people that kind of have cash coming in and they're afraid that they've missed the boat. And this is a very common conversation I'm having, is that, well, I'll just have to wait for the next pullback. And I do think that some of that is true, but there's a lot of psychology that goes into this idea of buying the dip. And I think it's a trap that a lot of people fall into, in that they'll wait. They'll think to themselves, the market will run up 20% and then it'll dip 5%. And they'll say, look, I got in when it dipped, when in fact you've missed that 15%. The research shows that over time, just getting in, the best day to invest is today. The second best is tomorrow. And there's not really a lot of backup. And obviously the timing's always going to matter, and there's always going to be time periods that you can pick and choose. But if you are looking to invest, don't worry too much about the levels of the market. Go ahead and do it from my standpoint.
And there was the period, leading after the financial crisis, where we had it's almost 10 years of no gains in the market. Mm-hmm. So the argument you're making there is, if you invest over the long run, 10, 15 years, you're going to be okay. And there was only sort of that one about 6-month period where the 10-year rolling rate was still zero or slightly negative. But after that, then of course we had an explosion of growth, and then people made a lot of money. But it is psychologically difficult when you've seen things go up. Well, let me put it this way: if I went into a store today and my pint of milk was $5, I mean, it might be a bit cheap. If tomorrow it's $10, I'm going to be pretty annoyed about that, and I'm going to try and hope and maybe wait a few days, or maybe petrol is more a better example, wait until it comes down. Yeah. It's annoying to see it keep going up and to having to spend that additional amount of money. So how does someone psychologically get over that hurdle? Like your point about the history, but it's still ingrained in human culture is to not want to pay more for something, and you are paying more because it's gone up so much.
Yeah, 100%. And we are living in this culture of YOLO, of fear of missing out.
You have to explain that one. Not all of us are millennials.
Well, I'm just barely, but
you only live once.
You do kind of have to. A lot of people just don't really understand why. Like they don't understand the justification of why a stock market could grow 30% in the middle of a pandemic when half the market's closed. And the answer, at least from my standpoint, is that interest rates have been absolute zero for over a decade for the most part. We had maybe 2 years there that we were just peaking up a little bit where we were back to a trajectory. But then when COVID hit, interest rates dropped right back down. And so when you're looking at kind of options for investment, there is not another option. And usually when there's the other side of the market, which is the bond market, if you can go and you can get yield or you can get returns, you can get interest rate payments that are 5%, maybe you'd rather just go take your 5% risk-free, basically. But in this situation, cash is not paying you anything. Bonds are not paying you anything. The 10-year U.S. Treasury, which is the best kind of default of a risk-free asset, is paying barely over 1%, 1.25%, basically, fully taxable for Americans. Most people are saying that's not where I want to be. Obviously, we have inflation of 5%. You're not going to invest for 10 years where you're only going to have 1%. You're losing on your money.
Yeah, that's the point. You're absolutely certain if you do that you're going to lose 2.5% to 3%.
Absolutely,
each year.
You're locking it in.
Yeah, you're guaranteeing a loss of 3%. So your 100,000 this year will be worth 97,000 next year, and then my maths is going to fail me. But you're going to be worth about $90,000 effectively in real terms.
Yeah, and so people are
crazy.
they're just choosing to take risk because they have to from that standpoint. And then you couple that with obviously very loose monetary policy and a lot of fiscal stimulus. There's just a lot of money in the markets right now. There's a lot of money freely flowing, the ability to trade for free, the ability to transfer money for free. There's just a lot of dynamics at work there that I think that do justify, from a broad market perspective, those values.
This record, though, has played before in the sense that there have been other periods in... Once upon a time, you would say in distant memories, but it's not so distant because it was 6-7 years ago. It was 20 years ago. Dot-com boom was free money flying around. And then after the financial crisis, there was free money. We've seen this record play before, and it hasn't always ended as well as people might have hoped. So the dot-com boom ended spectacularly. And a lot of the money that was invested in companies that were, shall we say, not making any money, perhaps just about making a product, ended up being worthless or completely collapsing. And that's presumably a worry that people would have today, which is things have gone up so much. Are all of these companies that I could invest in, some of which are making absolutely no profits, why the heck should I speculate in something like that?
Yeah, you think about, especially in environments like this where money is just so free, money is so coming, that you've got SPACs, which are special purpose acquisition vehicles, where basically managers can just go out and say, send me money and I'll go find a company for you. Don't worry about doing your own research or looking at it to yourself. Just send me a lot of money, and once I get the money, I'll just go and buy a company, and then it'll be public. And then we have a lot of companies just saying... And
it may or may not be a good deal.
Yeah, it may or may not.
But I as a sponsor, will make 5%, so I'll be happy.
Oh, yes.
So you send me $1 billion, I'll make 5%, and I might do something for you that's useful. But I don't, then it's your problem, not mine, because I've still made 5% of $1 billion.
Yeah, so you've got these SPAC vehicles going public, a lot of private companies that would normally have gone through the full kind of due diligence process of actually having prices, having their financials very publicly, going on a roadshow, really seeing what is under those covers for one side. And you're just not seeing that with the SPACs, and money flowing into it. It's new, it's exciting. Same with these meme stocks thing. I don't even hardly want to comment on it because it's ridiculous. People are living in fantasy dreamland, just chasing anything. But
you get free popcorn with AMC now.
Same with NFTs, same with crypto. All these assets that have no earnings and no operations for that matter. People are just chasing. They're chasing a dream. They're chasing a gamble. They're chasing a speculation. And, I hate to say it, but it's going to end badly.
But until it does, people want to play that game, and that's again part of human psychology. There's so many cases in history where people invest not because they think it's a good thing, but because their neighbor has, and they invite their neighbor around for a beer, and the neighbor says, "Oh, I made such a huge amount of money on this," and you think, "Well, that seems stupid." But then the second neighbor says the same thing, and you go, "Well, I might as well. What harm can it be?" And hopefully, you get out before the next person, in which case they're the fool and you're not. It's rather like playing poker. If you don't know who the well, I don't know what the expression is, but if you don't know who the sucker is, then it's probably you, isn't it?
And it can be fun. I mean, especially, you look at the last 2 years, you have the rise of kind of Robinhood and the gamification of, and obviously you and I know that it's fun. It's something that we've been doing for our entire careers, but there is these up times and then there's these down times, and you have to kind of learn through experience what you're wanting to invest in. And I'll be the first to admit that I've bought some just fun stuff here and there, but it's kind of, you're building on what your own wealth profile looks like, and that making sure that you've got your high interest rate debt paid off, making sure that if something happens in your life or an emergency happens, that you're going to be able to pay for that, then that you have kind of your retirement in place. And then making sure that only after those things have been taken care of, that's when you can start kind of, what I say, playing or speculating or gambling with stocks, having fun with that. Because in practice, some of these things will work out and some things will don't.
Do you think it's a danger that certain platforms, I don't pick on Robinhood, I just use that as a modern example, but certain platforms have made what's supposed to be investing very much gambling, and translated the experience of Vegas into, when one goes to Vegas, one does it knowing that it's play money. It's, you're doing this or you might be buying a new car or neither. And said, well, investing is supposed to be for long-term planning, for long-term saving, for retirement, for things like that. And it's turned it into a more of a gambling machine. Is that dangerous from a human psychology perspective, perhaps?
It is, but I have a little bit of mixed feelings, because in the past and historically, investing has been kind of something that's been very reserved for people that had the money versus people that don't have the money. So from a broad standpoint, I am actually very open to anything that really gets exposure to kind of the everyman being able to invest. So I think the first kind of step to that was kind of online brokerages. You no longer have to call and have your own stockbroker and have $1 million to be allowed to have your own
have
person.
to be allowed to have an account with them. I mean, goodness me, you've got to wear the right suit and
exactly. We can trade in a second. You can log on. You don't have to prove yourself. You don't have to justify yourself to anyone. You can go log on. Then the second kind of phase of that was the ETF and the index fund, especially. And
they very much democratized it by reducing the cost.
And I think it's been great. And then you kind of, now we've entered a phase where the costs are kind of hidden a little bit, that there's now paying for deal flow versus kind of a ticket of commission. Previously, to trade a stock at all, you would have to ultimately,
pay $10 to buy $1,000.
And those costs have been coming down, but as of last year, they've basically been eliminated from just a line item fee. Those fees are still there somewhere. Someone's always paying for. Nothing's free in the world. But you don't see it.
So instead of buying a stock at $40 and paying $10 commission, you're probably buying the stock at $40.01, which equates to the same $10. It's hidden within the system, so that it would be rather like going to Vegas and it says every time you play on this slot machine, you've got to pay $2 as an entry fee. You go, well, I'm not going to play that slot machine. The fact that the odds in the slot machine give you only a 20 or 30 or whatever the percentage chance of winning, no one cares so much about that because it's hidden.
Yeah, so that's, I think, has kind of exacerbated that problem a little bit. But overall, I am happy to have the access there for more people. I think that's going to be good, but it does give you just enough rope to hang yourself in some cases.
And also it gives people the scope to lose all their money, because it allows people to speculate in instruments which are complex to understand. So options are potentially complex to understand and can have very unintended payoffs if things go wrong. So if you've traded an option or you sold an option, it could mean you have potentially unlimited, and that sounds strange to say it, but it genuinely could have potentially unlimited losses if it goes the wrong way for you.
Yeah, 100%. And options are one of those things that's zero-sum game, right? There's a winner and a loser. Somebody wins, somebody loses. Versus stocks, you can buy a stock, every shareholder can benefit if it all goes up. Versus that's not the case in any kind of derivative security, or even in the case of somebody just asked me about a triple leveraged ETF the other day and why they wouldn't be buying it. And I've kind of sat it in my email because I need to properly send this. But I mean, it's a fair question of why wouldn't I look at these returns? It's returned 100%. and it's just the S&P. Why wouldn't I buy a triple leveraged ETF? It's like, well, it's going to change your risk profile a lot, and it's all good until it's not.
And I suppose the better way of probably doing that is to potentially use some borrowing within a securities account as opposed to buying an ETF which is intrinsically leveraged, because then at least so you've got your 100,000 and often it says you can borrow 50,000 against this and invest. Well, you know what your exposure is, whereas triple, it takes a 20% move and you've probably lost 100% of your money because of the implicit costs in there as well.
Yeah.
Which is dramatic.
Yeah, I don't even know why people do a lot of securities lending either. The rates are astronomical.
Well,
you might as well pay it on a credit card.
Yeah, or people, I guess, are trying to eke out any extra rate of return they can possibly get and do anything like that.
And in this environment where money's free, that's...
Right, well, let's take a brief break. We are halfway through our show, if I'm not mistaken, and then we'll come back and we'll explore some other avenues, shall we say.
Chamberpension.ky.
The Cayman Islands Chamber of Commerce Pension Plan. We're here for you. We are a non-for-profit member-centric plan with a democratically elected volunteer board of trustees representing all sectors of the Cayman Islands economy. Chamber Pension has an all-in expense ratio of 0.72% over 16,000 members, $430 million in assets under management. We were the first multi-employer pension plan approved by the regulator in the late 1990s. And today, we are still strong, secure, and are here for employees and employers alike. If you would like to join or request further information, visit chamberpension.ky. And for information as it happens, follow us on Facebook, LinkedIn, or Instagram. Email admin@pensions.ky or call 745-7630. The Cayman Islands Chamber of Commerce Pension Plan. We're here for you. Money Sense, the only personal finance radio show in the Cayman Islands, hosted by Simon Caudry from the CFA Society Cayman Islands.
This is Money Sense.
All right, and welcome to Money Sense with Simon and Amy, and we are just exploring hot topics today. So what is on your mind today? Is it inflation? Because that's what seems to be on everyone else's mind.
Yeah, I think it is really, and there's a few reasons for it. And it's a difficult one to get one's head around, because when people talk about inflation, what they generally think about is what prices they're paying, because that's what inflation is. But that's often not what policymakers care about. And it's a strange dichotomy of understanding. I go to the supermarket and things have gone up 15%, and they go, well, inflation is crazy. And policymakers say,
that doesn't count.
If you looked at the trim mean and take away all those things that have gone up and all those things that have gone down, actually the average price is close to 1% increase. And you go, that doesn't feel normal, but that's how policymakers act, and that's why interest rates have remained so very low. One of the reasons why interest rates have remained so very low is because policymakers don't care about strange inflation scenarios. And you mentioned this earlier. You said that inflation currently is 5%. Well, it's about 5.5%. What we all generally feel as an ordinary basket of goods. I think it was in the mid 1990s, because the rate of inflation became something that was quite volatile. It was, there's some prices in there which are a little bit pesky. They go up a lot and then they go down a lot, and so it's difficult to get a sense of it. So they came along with an inflation measure which excluded the price of food and energy, because those things are quite volatile. You know, what happens in the Middle East affects oil prices, and so inflation became a little too volatile. So you strip those out, and they said, the policymakers said, let's focus on that as the core measure. Well, actually, that measure today is 4.5%. So, that's a bit awkward for policymakers, because you've stripped out the things you've said historically you're going to strip out because they're volatile. And historically, if you strip those out, you've reduced volatility. So inflation has always been substantially lower. So now they have a new measure, which they call this median CPI measure. And that's a quirky one. And that, blessed be this measure, it's only 2.25%. So policymakers look at this and go, inflation is very well contained. There aren't any real problems. And that's very disconcerting to people who go to supermarkets, who fill up their car with petrol, who buy a house or rent an apartment. And in Cayman, we know this because prices almost continually go up. And it seems, well, why aren't policymakers doing the typical thing about that, which is restraining economic activity? And you mentioned this at the beginning. It's because there are other things on their mind, which is there's still massive levels of underemployment. There's still this pressure on recovery from a pandemic situation. And so they're willing to accept some sort of medium-term inflationary pressures. However, what troubles me about this, and I totally understand that policymakers want to look through these things, but what's quite interesting is when you survey people about what their view of inflation is, and it's quite a strange human psychology thing, because if you say to someone, inflation today is 5%, if you said, what do you think inflation next year is going to be? Typically, people say, 5%, because that's what they've just experienced. But then if you ask them a very similar but subtly different question, and this is actually done in the US, you say, what's inflation going to be in 5 years' time? And they go, well, it's 5% today. I think it's going to be 5% tomorrow. But in 5 years' time, I'll be back to normal. So the average expectation for 5 years is 2 3/4%. And I'm curious as to what your view, how people can experience such strange or such high levels of inflation and yet be so ambivalent about where it's going to be in 5 years' time.
Yeah, and I think you hit the nail on the head, at least from what I'm hearing in the market, and even from kind of that U.S. side. And it's that buzzword of transitory, right? That this is just COVID. We're just getting through this issue. We're still dealing with some backup supply issues, and that's why some of this is happening. But ultimately, we're still looking for a target of 2%, which is the long-term target of the U.S. in terms of inflation, before they kind of start to see that they want to start raising rates or ultimately reining back the economy. But you make a great point in terms of confidence with the consumer, and especially the American consumer. The American consumer drives the world. It drives the world's markets. And so when an American consumer, when you start to see consumer sentiment reduce, that's because of inflation a lot of times. It's because they are going out and they're saying, oh, lumber prices are 3 times what they should be. So they're gonna hold on.
Yeah.
You know, they're going off. You're not being able to unload these containers. You've got a labor shortage in the ability to get things from here or there. So people are like, I'm going to hold off. That is where you start seeing those slowdowns and some of those pockets where kind of these natural kind of relationships between world markets start to break down, just because you do have get some fear there. You get some thought in your mind that prices are not going to be the same today as they're going to be tomorrow. And we are in a weird way in that in some cases, technology in the world isn't infecting inflation in a opposite direction. And we see that a lot, especially when you look at Japan and a lot of the European countries. Think of like a TV. 10 years ago, you wanted to buy a flat screen TV like this one. It would have cost you $1,000. Now you can go to a garage sale and you get a flat screen TV for $100. So there is some technology advancement that is kind of keeping inflation at bay.
There certainly is, and there certainly has been, and I think you alluded to this, and I want to spend a moment or two on this because it's such an interesting area of research and topic, because historically the price of goods that we buy technology-wise has decreased quite rapidly because of advancements, and the sophistication of a device has increased rapidly. But that's been associated with supply chains that have worked.
Exactly.
And that's a very crucial point, because one of the things that's often considered a leading indicator of where things might be going is not what consumers are paying, because consumers buy finished goods. In other words, goods that are made. So you buy your iPad because it's been put together out of 5 gazillion different parts. But if the cost of those parts is increasing rapidly, eventually the cost of that iPad will start to go up. And producer prices right now are going up. So this is what manufacturers of goods are paying for their raw materials. They're going up over 10% a year. So if a manufacturer of something is paying 10% more today than he or she was a year ago for the same inputs, the cost of the thing he or she is selling is by definition not going to be lower next year. Mm-hmm. It could be if they want to give up and become a socialist organization which is only interested in returning wealth to its consumers and its customers, but that's not going to happen. So ultimately, it's likely products are going to continue going up. And one of the fascinating reasons for that is shipping. And you mentioned this. So I pulled together some charts for this because it's just such an interesting area. There's 2 charts that you can look at.
We're on the radio, Simon. So
no, I'm not going to pull them up and hold them up for people, but I pulled them up on my computer. So there's a chart which you can go on. Just go on the internet and you can look at this, and it's called the container freight benchmark rate. So everyone in Cayman is familiar with containers because they deliver almost everything to the island. Big boxes, 40 foot long, and you stuff as much stuff in them as you can, and you get your stuff to the island. And anecdotally, people in Cayman have said, prices are going up a lot. Price of building my house has gone up. Price in the supermarket. And you think, well, why is that? Well, we know inflation is 5%, so that explains that. We know oil prices have gone up, so the cost of transporting something has gone up. But from 2015 to 2019, the cost of buying a container and shipping it anywhere, a 40-foot container, was something between $1,000 and $2,000. That's what it cost. So you put your $50,000 worth of product in your container, a couple of $1,000 additional cost. Okay, that's manageable. That's a couple of extra percentage points. That same container at the beginning of 2000 was $2,000. Beginning of 2001, to rent that container, it was $5,000. So that's a 2.5 times increase. That same container today is almost $10,000.
Wow.
So when you think about why, and you relate this to Cayman, when you think about why prices have been going up, and people have said, well, cement costs so much, lumber costs so much. Well, those things actually don't go in the containers, they go on flat boats. But when the costs of shipping something has gone up 10 times or 8 times, it's quite obvious why products and prices have gone up in Cayman. And that's not because of oil prices, but that's just simply because of disruption. So you can't now get products into and out of ports very easily because people aren't working, because people have COVID and they're unable to, or because of social distancing. So there are stories in China and there are stories in California about boats which normally would take 30 days to enter and exit a port are now taking 3 or 6 months.
Right.
Well, that means that there's a lack of ability to move stuff around the world, and there's a lack of containers, so supply and demand. In order to get one, you've got to pay a lot of money for it, and that clearly has impacts on consumers. And that's a problem, because if those sorts of things are continuing to go up, and this is something that just 2 months ago, this same container, instead of $10,000 was $8,000. 2 months before that, it was $6,000. So prices in Cayman, as an example, if that's what it costs to move something into this island, we should expect to see prices continue to go up. And that obviously will be problematic for consumers here.
Yeah. And then you got your containers in the wrong place, ultimately, because they're sitting in the wrong port empty for too long, twice as long as they should be. And it's just exactly what you said with those supply chain mechanisms that underline really everything that we do is breaking down kind of how free trade should work around the globe.
Yeah.
Well, we got like 3 minutes. What do you think?
2 minutes.
2 minutes.
Even less than that, because we've got to do our little thanks and all the rest of it. But I'll finish with one thing, because it's a hot topic with people in Cayman in house purchasing and such like. And you mentioned lumber, and lumber is something that went skyrocketed and then has fallen back quite a lot. But a lot of materials that we use in construction are shipped not in containers, but they're shipped in other vessels. And it's associated with a Baltic Dry Index. So you can, again, look at that on the internet. This same thing has gone up from, at the beginning of 2000, to ship something on a flat boat would have cost $500 to charter this boat for a period of time. The same charter rate now is $4,300. And that's what we ship cement on, that's what we ship lumber on, that's what we ship steel on, that's what we move everything to do with the construction industry in. So anyone who's thinking about buying a house in Cayman or building a house, prices are only going to go one way in terms of the cost of doing it. Whether that means the market in Cayman is overvalued, there's some expensive properties in here which 5 years ago looked expensive and now look very expensive. But if you want to reproduce exactly the same building stock we've got here, it's going to cost you probably twice as much as it did 5 years ago, just from the raw material thing.
Yeah, and I saw a graph, the same thing's happening in the U.S. there, where used homes are now surpassing the price of new homes, just because of the ultimately input prices and the delays that you're gonna run into.
Which is extraordinary, isn't it? It's cheaper to buy a used home. Well, sorry, hang on, which way around did you say? It's cheaper to buy a new home.
No, it's cheaper to buy a used home.
A used home, yeah.
Which, you've got.
Yeah, rather than go through all that, because you're going through the hassle of building a new one. Most people would say, prime piece of land, put a new home up, it's going to cost me less. Not now. Well, we are, unfortunately, as close to out of time as we can possibly be. So I don't think we've defeated all the world's problems and answered all the world's questions, but we've made a bit of a stab at it.
We'll have to do a follow-up.
Yes. I wish your team well in the upcoming college football season. I don't think anyone expects success, but you never know.
Oh, we always expect success,
okay.
and I wish
You
your
are
team
American.
well in the cricket.
Yes, cricket. England are playing India today, fourth test, important game. That's a complete digression, and apologies to our listeners and viewers, and Susan as well, who has no care for this little
We're already
ramble.
thinking to the weekend.
We are out of time. It's been a pleasure having you join us on the radio this morning. Thank you for your time. If you do have any topics or questions or conversations you'd like to hear us cover, or guests that you want us to interview, then please do let us know. Send us an email to moneysense@candw.ky, or tweet us, which is @MoneySenseRadio. With that, thank you for joining us, and please do tune in 2 weeks' time.
The Cayman Islands Chamber of Commerce Pension Plan. We're here for you. Are you aware of the performance of your pension plan? The Cayman Islands Chamber of Commerce Pension Plan provides quarterly fund fact sheets for our members to stay informed with the plan's performance. For the year ended 30th of April, 2021, the various life cycle funds have provided returns between 10.5% and 43.2%. And our all-in expense ratio for year ended 30th of June, 2020 is currently the lowest it's ever been, 0.72%. Visit chamberpension.ky to review our fund fact sheets. You can see the performance as far back as 10 years. Remember that pensions are a longer-term investment strategy. Focus on the long term rather than the short-term returns. The Cayman Islands Chamber of Commerce Pension Plan continues to perform for you. Money Sense is brought to you by the Chamber Pension Plan. For further information, visit chamberpension.ky. The Cayman Islands Chamber of Commerce Pension Plan. We're here for you. Please be advised that the pension contribution holiday has been extended until 31st of December 2021. Employers and plan members should ensure arrangements are in place for salary deductions and remittance following this date. The Cayman Islands Chamber of Commerce Pension Plan, keeping you informed. For further information, visit chamberpension.ky. And for information as it happens, follow us on Facebook, LinkedIn, or Instagram. Email admin@pensions.ky or call 745-7630. We're here for you.